Before we get into the P&L format for financial modeling, let's first take a look at cash and non-cash expenses. Cash expenses are any of those that involve an outflow of cash, and cash expenses make up the majority of expenses on the P&L. Some common examples include utility payments, building repairs, auto lease payments, employee salaries, and so on. Cost of goods sold is also a cash expense, even though the cash outflow, which is the purchase of inventory, has already occurred. And by contrast, a non-cash expense is one that does not involve a cash outflow. The two most common non-cash expenses are depreciation and amortization. Depreciation is the P&L entry that reflects the wear and tear of long-term fixed assets, such as real estate, manufacturing equipment, company vehicles, and so on. These assets have long useful lives and require large cash outlays up front, and over time, depreciation expense is used to recover the cost of these assets and to reflect the amount of usage that the assets have undergone. Amortization is another common non-cash expense that reflects the use of intangible assets, such as patents, goodwill, and trademarks. These assets also involve large outflows of cash, and amortization is used to recover the cost of these assets over time. Now, depreciation and amortization can be recorded in several ways. The first, and one of the most common, is what's called straight-line depreciation, which is where the company depreciates or amortizes the assets evenly over their useful life. The formula for straight-line depreciation is purchase price minus salvage value divided by useful life. Salvage value represents the asset's estimated resale value at the end of its useful life. So, for example, if we purchased a $150,000 piece of manufacturing equipment with a 10-year useful life and a $25,000 salvage value at the end of year 10, under straight-line depreciation, we'd record a $12,500 depreciation charge per year for the next 10 years. And similarly, if we bought a $50,000 patent with a 10-year life and no salvage value, we'd record $5,000 of amortization per year for the next 10 years. It's also common for companies to use accelerated depreciation methods, where depreciation is weighted more heavily in the earlier years of an asset's life cycle. One common accelerated depreciation method is called the double declining balance, where assets are depreciated at twice the rate of straight-line depreciation. The U.S. tax code also allows companies to use what's called the Modified Accelerated Cost Recovery System, or MACRS for short, and this is another form of accelerated depreciation. Now, it's important to separate cash expenses from non-cash expenses when building financial models, and we're going to discuss this more in detail in the following lesson.